Hi, I'm Mike Coe, and I'm taking your open interest. Do you have a question or a comment that you're hoping I will address? Please tweet me at Michael_Coe, and I will try to answer it. And if you would like to see my responses to some other inquiries, you can check out the YouTube channel, and we have them kept there. So let's take a look. Camo Options asks, at Michael Coe, I bought two 680 naked call options for Tesla right after earnings. The timing couldn't have been worse. I'd like to avoid the usual buy high, sell low. How can I salvage this option? It has a September 17th expiration. Any coaching for us? Mahalo. Okay, yeah, this is a pretty tough situation. Let's just take a quick peek at what happened here. So first of all, what I have on my screen right now, and I should probably cover myself up because I'm not showing the most recent days. This is a price chart of those September 680 calls since April 26. Now, they reported after the close, so this actually captures the price of those call options from the beginning of April 26 to the present. And as we can see, they've fallen pretty sharply. It looks like they were about 140, but since you said that you bought them after they reported earnings, my assumption is that you didn't actually pay that April 26 price. Nevertheless, they've fallen quite sharply. You might be seeing a loss of somewhere in the neighborhood of $60 to $80 a contract, or $6,000 to $8,000 per contract, because, as viewers will know, each contract represents 100 shares. So we multiply by 100 to figure that out. Okay, so what are we going to do here? Well, the first thing you have to do when you're looking at a situation like this is consider your view for Tesla more generally. Okay, so let's take a look at that. And again, I'm going to get rid of my picture because I'm covering up part of this. The bull case. I think this is well understood, well known. Tesla, phenomenal product, phenomenal brand. You know, I think when people think of electric vehicles now, they most often probably think of Tesla. This is a company that didn't manufacture cars, was the first company to actually produce and sell a car that got a perfect score from Consumer Reports. That was for the Model S. They got a perfect score of 100. And in fact, Consumer Reports actually had to adjust the way that they actually scored cars because of that. The cars are exceptional. And a lot of people who are interested in electric cars, that's the only brand they'll consider. Full disclosure. We have two cars, an electric hybrid, which is a BMW, and my wife drives a Tesla. She wouldn't consider anything else. And there's no question when I talk to my kids and so on, they think it's the only car to get is a Tesla. Important thing about this company, too, it benefits immensely from the sale of credits. So zero-emission vehicles are basically a requirement for all of the auto manufacturers. They have to sell some. If they don't sell enough as a part of their product mix, they can offset that by buying credits from companies like Tesla, which only sells ZEVs. So this is really important because this has amounted to probably about $1.6 billion or so current year revenue forecast for full year 2021, $4 billion, I think, off the top of my head in revenues since the inception of the company. So this is a big benefit to Tesla in the sense that as long as Ford and GM and other companies continue to sell internal combustion engine vehicles and they need to offset that, then they would be buying credits from Tesla. And of course, it's not just U.S. automakers that are doing this. So they benefit from that. That is both a benefit, though, and a potential risk. We have the Biden administration contemplating the extension of tax credits. So many viewers may know that to spur the sale of electric vehicles, they introduced a $7,500 tax credit that would be awarded to the consumer. Now, that has a phase out based on the number of vehicles that are sold. Tesla has long since seen the phase out of their tax credit. So if you go out and you purchase a new Tesla, again, many viewers will probably know that, you don't receive the $7,500 tax credit. Other companies that have not sold anywhere near as many ZEVs still have those. So if Biden extends the tax credit, that will make Tesla vehicles more competitive. So for example, a BMW that has a $7,500 tax credit is priced against a Tesla, which does not. So if Biden extends those tax credits, that's going to help them. Obviously, their target of getting to 1 million vehicles annually depends heavily on China. And that's obviously a potential bull case if you're taking a look at their production numbers. And we haven't even seen the release yet of the commercially available Tesla light and heavy trucks. So the light trucks would be things like the Cybertruck, and the heavy trucks are like the Class 8 type trucks that Elon rolled out in one of his presentations. Okay, so what about the bear case? Legacy automakers are launching EVs. Some of them are very good. So that increases competition. Now, if the existing automakers produce enough of these, that will also simultaneously reduce their demand for the credits that they're currently purchasing from Tesla. Another potential bear case for Tesla could be made on valuation. I don't need to tell many of you this, but the fact of the matter is that if you compare Tesla just simply as an automaker, and I'm not saying that's all it is, but if you did, to other automakers, its price per unit sold, its price relative to earnings, its price enterprise value relative to EBITDA, there's no comparison. It's a much, much more richly valued company. A lot of that premium is probably justified, but some may argue that not all of it is. And that's a potential part of the valuation concern. The other thing is that when you're looking at automakers, the most profitable ones typically sell more high-end vehicles. So, for example, the profit margin on a Cadillac Escalade is considerably higher than it is on a Chevy Cruze, both GM products. If you take a look at the margins on a Porsche Taycan Turbo S or a Porsche 911 Turbo S, the margins on that are going to be considerably higher than they are in a base level Macan. So higher end vehicles tend to have not just more profits because they cost more, but the margins themselves tend to be broader. So as Tesla becomes more competitive in lower priced vehicles, that is going to hurt their overall profitability and margins, all else equal per unit sold. And of course, they're trying to focus on this, and many of you will probably also be aware that Elon specifically spoke about introducing an even more entry-level vehicle. That new entry-level vehicle, by the way, is going to be priced, around $40,000, so a little bit less than the Model 3 is currently. Some people are arguing that's still an expensive product. However, I would say that when you take a look at the total cost of ownership, that's probably something that more people are going to be focusing attention on. And as gas prices rise, if you happen to live in a place where gas prices are very high, as I do in California, sometimes we're looking at prices that are closer to $5 even than they are to $4. Electric vehicles tend to be, when you take a look at all of the costs, much more competitive. Okay, so what's the verdict here? First of all, if you're in this position, you have to say, what's your thesis on Tesla now? I've presented some of the fundamentals. I'm going to leave it to others to try to articulate what the technical view is here. But I think it's important to point out that those September 680 calls, and now the way I look at the probability of profit, a simple way to think about whether or not that trade is going to be profitable is you take a look at the break-even, and then you look at the delta of that break-even. What's the likelihood, just back of the napkin, that the stock is going to be above the break-even point at expiration? So expiration is September 17th, as you pointed out. The break-even point is round about $715 for Tesla right now. And the way I got there, $680 strike price, $35 option price, 680 plus 35 gets you to 715. So to understand the probability of profit at expiration, at back of the napkin way to look at that is to take a look at delta of the strike and expiration. So right now, there's only about a 25% chance using this method that this is actually going to be profitable at expiration. Now, Of course, Tesla has been substantially above 715, has been over 800 in fact. But right now, the options market is assigning a relatively low probability. So something else to think about. We only trade from settlement. So I can fully appreciate the fact that, you may have paid $80 a contract for these, $100 a contract for these. Now they're only trading around 30 bucks and change. It's very difficult when we see losses like this to actually realize that loss. Sometimes, though, that is the best thing to do. Quick rule of thumb, some folks will take a look at options that they buy, and if they decline to approximately 40% of the initial premium paid, they'll just stop themselves out. They'll take the trade off and say, I'm going to reevaluate my position and move on from there. However, I can appreciate, though, that the risk and reward dynamic has also changed, because when options become considerably less valuable, it's only their current value that you're continuing to risk if you continue to hold them to expiration. So another way to think about it is much of the potential loss has already taken place. So, you may or may not want to realize those losses. So one quick point I would say, I checked with a couple people who are technical analysts. Not clear to me, given the big range that the stock has had, where there would be an obvious level of support in this thing. Although I will say that as of yesterday, anyway, the relative strength on it was getting quite low. Sometimes that can create an intermediate period of support. Okay, so you indicated that you don't want to sell or close your existing position. But if you don't like some of the things that I've outlined here, you don't like the odds, the probability of profit, if you don't like the fact that the break even of $715 is considerably higher than where the stock is now, then the only remaining option that you have is to spread. So if you can't close your existing position, then the only thing that you can do, other than do nothing, is spread. So what are some of the spreading options that are available to you? One of the things you could do, of course, and that sometimes people will do, is they'll try to sell higher strike calls against the calls that they own. I don't advise that here, though. A couple of reasons for this. One is that the amount of premium for significantly out-of-the-money options relative to the 680s you own in September isn't going to be that great. The second thing is that if, for some reason, the stock really did rally, between now and then, you're not going to fully realize the difference between the strikes. And finally, longer-dated options simply don't decay as rapidly, certainly as a percentage of their value, as nearer-dated options do. So that's one of the reasons we frequently use calendars and diagonals. A diagonal where you're long the 680s and short a higher strike isn't going to work here either. Why is that? Again, the stock has fallen so sharply that selling strikes of, say, June options that are higher than 680 aren't going to bring in much premium. However, one thing is interesting about the position that you have, and that is that you own two call options. And what we can contemplate here now is a ratio spread. So if you feel that the stock might be a little bit range bound in the near term, you don't need to sell a call option against every option that you own. If you own two September 680s, you could say sell one June 600 or one June 580. I think right now the stock is trading above 580, but the 600s were actually priced fairly close in June. Were priced pretty close to the September 680s. So you could actually sell one of those. Now, this is kind of an inverted diagonal. You would be selling one lower strike call option against the two higher strike longer dated call options that you own. But I will point out that because you own more options than you're short, even though you'll see a dip in profitability if it runs through the short strike, there would be no situation where you would see losses relative to what those call options are worth right now between now and June expiration if you did this trade. It would curb some of that potential upside. But if Tesla is a little bit stuck in the mud here, that is one thing you could do. All right, so this was a rather long-winded explanation. I apologize for that, but I hope this helps you. For those of you who have an open interest of your own, got a question or a comment, please tweet me at Michael_Co, and I'll try to answer your questions too. And do me a favor, Give a like and subscribe if you like this kind of content so that I continue to try to provide it for you. Thanks very much.